Welcome to Technical Tuesday. My name is Fred Razak, Senior Trading Strategist here at CMTrading. And today we're continuing our money management series. We're discussing hedging strategies. But before we start, make sure to smash the like button. And if you do find value in this presentation, make sure to share with friends and family or like-minded traders as yourself. And lastly, don't forget to subscribe. Now, jumping into hedging strategies. Now, this is the back end of money management. The reason I say it's back end is because it's not directly related to money management. When I say money management, the first thing that comes to my mind is preserving capital directly, making stop losses based on either technical or psychological stops or anything to preserve my capital directly. Now, this is indirectly, and the reason it's indirectly is because it's on the back side. What does that mean? So, okay, many times when I see clients coming into CMTrading, they take a position in the same symbol and they take opposite positions. They buy and sell the same underlying assets. So they buy the Euro USD and then they sell the Euro USD, keep two open positions, and they say, hey, Fred, I'm hedging. Well, you're not hedging, you're Xing, which means basically no matter what happens in the market, you're not going to make money. Because on the position that you bought and it's going to go higher, you're going to be losing on the short position. And if the market goes down, you're losing on the long position. So that's not called hedging. What is called hedging is taking two separate assets that have an inverse relationship, meaning to say that one asset goes up and the other asset goes down. Now, this is not the most hedging kind of position to take, but it is hedging. And what that means is for example, let's take two assets. We have the Dow Jones, which is the largest index in the United States, which represents companies, let's say before 1990, predominantly, okay? Because by 1990, that's when all the tech stocks started listing. Most of them started listing from 1980 to 1990, started listing on the NASDAQ. And so the Dow Jones represents, the financial companies, the healthcare companies, the conglomerates, the automobile companies are all listed on the Dow Jones. That's what it is, okay? Now, when the Dow Jones goes up, okay, we have an inverse relationship with the dollar, okay? So if the Dow Jones goes up, the dollar goes down. And that means that if I take a long positions in the Dow, that means the inverse relationship will happen to the dollar. Now, we are today, June 13th, 2023, and look at a graph from look at a chart from yesterday's trading, no matter when you see this video. On June 12th, 2023, we saw the Dow Jones perk up above resistance line of 34,000-ish, 300-ish, and we saw the Euro USD climbing higher versus the dollar. That means the dollar got weaker in the same day. That was an inverse relationship. So what does that mean and how does that work out? Okay, so basically what that means is you take one long position and you buy the Dow Jones, and then you take the opposite position and you sell the US dollar. So you've got two positions exposed to the market. One is long and one is short. And basically, if one follows through, almost certainly the other one will follow through also. Now, what if the other one doesn't follow through? You're still making on one of the trades money. Okay, so yes. Is it exposing yourself to the market more? Absolutely. But there's a switch side to that that's a benefit. And that switch side is if one asset is not working towards your favor, there's a likelihood that the second asset will. That's the argument. Now, technically speaking, this doesn't happen every single time, but it happens often enough to make it a correlation that's an inverse relationship between the Dow Jones and the dollar. Now, there are dozens, if not hundreds, of assets in the market. And you could Google it, inverse relationship between two symbols, and you will find a list of them. Now, the point is not to find every single one of them, but to find the one that you see mostly correlated with certain other factors included, whether we're in a breakout position, just like we were yesterday on the Dow Jones as we were inching higher and the NASDAQ pushed us higher, or we're in an inverse relationship where the euro is looking to break out, okay? So it's two assets, and that's the beauty of it, because when we say relative strength, it's got to be relative to something else. We can't ever define anything without expressing it to something else. There's nothing that you can ever define without expressing it to something else. There always has to be a counterbalance to something, and that's this on a deeper level. But technically speaking, this does work enough for it to be something that you could utilize in order to integrate into money management skills. Thank you for joining me this week on Technical Tuesdays. We'll see you here next week.